Okay, good afternoon, everyone. I welcome you all to today's training session, which is going to be on financial planning and bookkeeping. Training for today is going to be on financial planning and bookkeeping. It is expected that at the end of this training session, you, the participants, should be able to, one, understand what we mean by financial planning activities, two, differentiate long-term from short-term plans, three, understand reasons for bookkeeping, the main reasons why financial record is so important for businesses. Four, identify bookkeeping methods available to companies while trying to manage their financial records. Five, record financial transactions as far as time permits. Then six, balance of the books. The act of balancing the book is a bit tricky, especially for those who do not have accounting background. We'll see how this can be taken care of also as time permits. So let me start off by telling you this saying that you can't run a healthy, successful business without having your books in place. It is very, very impossible for you to run a healthy or successful business if your financial records are not put up to date. Any attempt to do that, you will be likened to a driver who drives a car without a fuel gauge or a fuel map. And what happens when somebody drives a car without a fuel gauge or a fuel map? Discover that the person runs out of fuel unknown to him or her, and the car will be forced to be towed or pushed aside. This same thing, this same analogy applies to businesses. We are saying that your business may not function effectively or successfully if there are no financial records or bookkeeping activities in place. That's why we're here this afternoon to discuss all the nitty-gritty that borders on bookkeeping and financial planning, how to plan our finances. So let's start off by looking at what we mean by financial planning. Financial planning is defined as a plan needed for estimating the fund requirements of a business and also ascertaining the sources for same. When we talk of financial planning, we are referring to a whole lot of activities that will require you as an entrepreneur, as a potential investor, ascertaining how much is needed in terms of naira and kobo for the proposed business of yours to be established. And having identified or estimated the fund requirements for the proposed business, you need to also ascertain where, in terms of the source, where the money will be gotten from. So all of these activities is what we refer to as financial planning. It essentially includes generating a financial blueprint for companies' future activities. When we talk of financial planning, it is that process of trying to generate a financial blueprint for your company's future activities. You want to decide how your company should operate in the nearby future in terms of its financial dealings. That's what we refer to as financial planning. So before us are objectives of financial planning, main reasons why companies engage in financial planning activities. They are listed before us. Number one is to ensure availability of funds. Companies plan their finances. Companies engage in financial planning activities. Why? Because they want to ensure that funds are readily available for the intended business they want to go into. That's number one. Two, to estimate the time and source of funds. When you plan your financial activities, you're invariably estimating the time in terms of when the funds will be needed for injection into the business, because the timing is very, very important. And let me say here that every fund that is injected every fund that is injected into a business, that fund has what we call attendant cost of capital. That is cost of capital that the fund attracts. Be it a fund that you have taken as a loan from a bank, even the fund you are seeking to get from NISA Microfinance Bank, of course, you know, that is what we call cost of capital, interest charges, borrowing cost attached to it. So in order to minimize this cost of capital, the interest element, you need to estimate the timing of the fund requirements to ensure that the funds are taken when they are immediately needed. That's one. And also the sources of the fund. It's not just enough for you to identify that you need X amount of naira for the proposed business to be established. You need to also identify where that's the source of the funds. Ask questions such as, where can this money be gotten from? Can it be gotten from NISA Microfinance Bank? Can it be gotten from any commercial bank? Or can it be gotten from any money market banks? So you need to be certain of the source of the funds. Then thirdly, another reason or objective of financial planning is generating a capital structure. You need to generate a very balanced capital structure for the proposed business of yours. What do we refer to capital structure? Capital structure is split of the fund, total fund injected into the business between what we call equity and debt. For every fund that is injected into a business, the fund would have been gotten from either equity or debt. What is equity and how is it different from debt? Equity is the total fund contribution by owners of the business. Just like you listening to me, any money you inject into the business, that fund that you have individually saved up, you and every other partners, the shareholders, the equity participants, all the funds you have been able to save over time and you have injected it into the business, that fund is referred to as equity. So simply put, equity is fund contributed by shareholders and equity participants. While the other fund that is borrowed, that comes as debt or loan, we refer to it as debt. Any amount you borrow is referred to as debt or liability, as the case may be. So when deciding a capital structure, you need to be sure that your capital structure is well balanced, thereby ensuring that your debt, your liability, does not exceed the equity you are bringing on board. It makes no sense for you to allow your capital structure to be highly geared in the sense that your fund, total fund injection into the business, majority of them is being contributed as loan. You will only be safer if majority of the fund for injection into the business is contributed by you, the equity participants, you, the shareholders, to prevent or minimize the possible risk of business takeover, insolvency, and liquidation, as the case may be. So generating a well-balanced capital structure is a major objective of financial planning activities. And lastly, avoiding unnecessary funds. This is also a reason why companies engage in financial planning activities, to avoid unnecessary funds from being tied up. You see, for every fund that is injected into a business, that fund has cost of capital, just like I told us earlier. Even if it is the fund, the money that you, the business owners, are contributing into the business, there is cost of capital that the fund will bear. Be it the money you have taken from a lender, maybe you have taken funds from NISA Microfinance Bank, it also has attendant cost of capital, borrowing cost, interest charges, as it is sometimes called. So for you to minimize this borrowing cost interest charges, to bring it to the barest minimum, you need to ensure that the funds are taken up when they are needed, so that you can minimize your borrowing costs, your finance charges. So these are some of the objectives why entities, why companies, why entrepreneurs, why businessmen and women engage in financial planning activities. There are basically two types of financial plans. We have the long-term financial plans. The long-term financial plans is sometimes referred to as strategic financial plans. And long-term financial plans consider a number of financial activities which include: 1, propose fixed asset investments, research and development activities, marketing and product development, capital structure, sources of financing. So when a plan borders on any of these activities that we have mentioned, you certainly know that that plan seeks to address a long-term financial issues. Let's take, for instance, the number one example under these long-term financial plans, which is the proposed fixed asset investments. If you, as an entrepreneur, a businessman or woman who is seeking to go into business anytime from now, you are proposing to acquire a fixed asset. A fixed asset is any asset of a company that is used for revenue generation, which is expected to last over 1 year. So a good example of fixed asset in this instance will be motor vehicle, office furniture and equipment, plant and machinery, maybe your generators, so on and so forth, your lands and building. These are fixed asset investments. So I want you to picture being in agricultural business. You are involved in farming. And for the fact that you are involved in farming, crop cultivation precisely, you have hectares of land available to you on which you farm. So your proposed fixed asset investment will be tractor. A good example of your fixed asset is going to be tractor, because you need these tractors in order to generate revenue. And these tractors are expected to last over 1 year. So if you are considering how this tractor should be financed, how to make investments in this tractor, this proposed fixed assets, such decision borders on long-term financial plans. The options available to you as an entrepreneur will be, on one hand, one of the options will be buying this tractor outrightly. That is, if you have the liquidity, if the cash is available to you, you want to procure these tractors outrightly by going to any tractor supplier, issuing a check or a transfer, and asking that the tractor be delivered to your doorstep, to your business premises. That is one option available to you. Another option will be financing the tractor through hire purchase, what we call finance lease. So if you have decided to pay through a finance lease, is the second option. Whichever option you choose, you are trying to plan your finances. And this, because it borders on proposed fixed asset investment, it is a clear example of long-term strategic financial plans. So when you consider also research and development activities, activities aimed at developing a product or prototype before production is commenced in commercial quantity, that research and development activity borders on long-term strategic financial plans. Capital structure, I've explained before, trying to balance your capital requirements to be sure to ensure that the total equity, that's fund contribution by you, the shareholders, and every other equity participant, the owners of the company, the financial contribute you inject into the business is more than the amount you have to borrow. I want you to bear this in mind. It does not augur well. It will not augur well for you if you base majority of your financing on loan. It puts the business at risk of gearing. We call it gearing. it is expected that you ensure that your fund contribution into the business outweighs how much you have gone to borrow. Take, for instance, if you know you need 10 million for the proposed business to be set up, it is advisable that at least 50% of it, which is 5 million, 50% of it should come from you, the equity participant, you, the shareholders, while the other 50% can come as borrowing. So this is what we mean by deciding on the capital structure, the sources of financing, the source where this money should be gotten from, the source where this money will be gotten from is also another source of is also another activity under the long-term strategic financial plans. Okay, so these plans are generally supported by a series of annual budgets and plans. Okay, excuse me, I will need to go on break now. Please, there is an emergency I need to attend to. And I'll be with you shortly in the next 5 minutes, please. There is an emergency I need to attend to, please. Oh my God, no, yeah, it's true. Mm. Okay, my apologies, please. I had an emergency I needed to attend to. It's up to 5 minutes. Maybe 5 minutes. It's up to 5 minutes. So it's up to 5 minutes. Okay, welcome back. Apologies for the interruption. So sorry about that. So let's continue. So we said another financial planning, long-term financial planning activity will include sources of financing. So when a company is trying to decide how to finance its business, its activities, that borders on long-term strategic financing. So sources of financing, if the company is considering where these funds are to be gotten from, if it's to be taken from NISA Microfinance Bank, whether it should be taken from any commercial bank or any discount house, as the case may be. So this decision borders on long-term strategic financial plans. So these plans are generally supported by a series of annual budgets and profit plans. Let me say here that for you to identify that a plan is of a long-term strategic financial plans, you basically need to consider the number of years that the plan is meant to last. If a plan is drawn up for 3 years period and above, you certainly know that that plan is a long-term strategic financial plan. The moment the period of the plan is up to 3 years, you have a plan that you have drawn up to address certain business issues in 3 years' time and above, clearly tells you that such plan is a long-term strategic financial plan. So even as you may have a long-term strategic financial plans, you also need to come up with annual budgets. Annual budgets, when collapsed or when consolidated, will also give us the long-term strategic financial plans. So the second type of plan, the second type of financial plan is short-term operating financial plans. Short-term operating financial plans is the other type of financial plan. Short-term operating financial plans specify short-term financial actions and the anticipated impact of those actions, and typically it covers a 1 to 2 year operating period. So if a plan addresses financial issues for just 1 year, it therefore means that plan is a short-term financial plan. Short-term financial plan is sometimes referred to as operating financial plans. So once the period of the plan is between 1 to 2 years, you definitely know that the type of plan is a short-term operating financial plans. On the other hand, if the time frame of the plan is up to 3 years and above, do know that that is a long-term strategic financial plans. Please take note. Examples of short-term operating financial plans will include management of working capital. Working capital comprises both current assets and current liabilities. Examples of current assets are receivables, cash, inventories, and all that. So imagine the company is trying to design models for its receivable management. Receivables are those customers who buy on credit, and as such, they now owe a company. So if your customers buy on credit from you and you are trying to design a credit system, how to manage your credits to be sure that no customer owes your company for too long, or part of the amount that is being owed does not go bad, it doesn't result to bad debt. So you may come up with plans on how these receivable balances are to be managed or to be collected, such as bringing up credit policy by allowing customers a maximum of 1 month's credit policy. So all of these plans, all of these actions you are putting in place is referred to as short-term operating financial plans. So don't forget, the time frame that this plan covers gives us an idea as to the type of plan it is. If the time frame is 1 to 2 years, you do know that it is a short-term operating financial plans. But if the time frame of the plan is 3 years and above, you definitely know it is long-term strategic financial plans. So cash budgeting is a very major tool, important tool for addressing or for planning our finances. Even as we have talked of financial planning, a major tool that is used in achieving financial planning objectives and goals is cash budget. What then is cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. So when a company prepares its cash budget, the company is simply aggregating all the total cash inflows. In other words, how much the company has received in terms of sales and every other income, and also deducting all the total cash outflows or cash payments that the company has made. So this will invariably leave the company with either a surplus cash budget or a deficit cash budget. A surplus cash budget connotes that the company in question has been able to generate or receive, collect more cash than it has expended. So imagine if you are able to receive your total sales, cash sales for the year or for the period, you have received 5 million. That's your total cash inflow. And you're able to spend 3 million for the same period. You see that what you have received, 5 million, is greater than what you have spent. So it will leave you with a surplus cash budget. But if on the other hand, you are spending 7 million as cash outflow, whereas you have received only 5 million as total cash inflow, it means that all your total outflow, the amount you have spent for that particular period, is higher than what you have actually generated or received. And this will leave us with a shortfall of cash budget. So every rational investor will always strive to have a surplus cash budget. So typically, monthly budgets are developed covering a 1-year time period. Budgets are usually prepared monthly, and from monthly, they are translated to annual budgets. So monthly, you can have annual budgets. So budget cycle. Here is a typical cycle for budgeting. Number one, under the budgeting cycle process is performance planning. Under the performance planning, a company sets its objectives or goals for the particular financial period. So number one budgeting cycle, number one budgeting process is determining the goals or objective of the company, which is what we refer to as performance planning. You need to plan your performances. Then secondly, providing a frame of reference. Frame of reference here is deciding on the benchmark, on what benchmark to be used in attaining your goal. So appropriate benchmark will have to be selected by the management of a company. Then we go into implementation proper, implementation of your business activity. Implementation is the next budgeting process, implementation. So let me give you an instance. Imagine if you're a farmer, you want to go into farming for this farming season, the next farming season. So your objective may be you're under the performance planning, which you said is clearly defining your objective and goals, which is the number one step. You may have an objective by saying after the planning, after the farming season, you want to have a particular tons of your crops that you have farmed. Maybe you're involved in farming of maize. After the farming season, I want to have harvested 10 tons of maize. That is your goal. That is your objective under the performance planning. Then the frame of reference is the benchmark you have to set. Benchmark has to be set in order for the goals or the objectives to be realistic, because it makes no sense if you set goals that will be unattainable. Your goals should be attainable at every given point in time. So setting the benchmark here, following the example that I have given you involving in farming, you may want to ask on average how many hectares how many tons of maize can you possibly harvest from 1 hectare of land. So that is how to establish your benchmark. Then implementation in this case, because we want to go into farming, the implementation will be engaging in farming activity proper. That's implementation of the whole activities. Having implemented, you have to investigate variations because your results may turn out to be different from what you have budgeted. Most cases, budgets will differ from the actual results, and you have to investigate the possible reasons for the variations. Why is it that you targeted to have 10 tons of maize after the farming season and you were only able to harvest 7 tons of maize? Why the variance? Why the shortfall of the 3 tons? You have to investigate the possible causes. Then, having investigated possible causes, you take corrective actions. Corrective actions here means ensuring that some of the impediments that hindered on the attainment of your goal in any particular financial year are forestalled. You forestall the reoccurrence of some of the ugly incidences that hindered on the attainment of the goal you have set. In this case, going by the farming example that we have given, in this case, you may want to find out why you didn't harvest the 10 tons as initially budgeted. Give it that you used a wrong farm inputs. Maybe the kind of seedlings you planted was not the right type of seedling. You also want to inquire if planting was done at the right time or planting was done a little bit late. Even the fertilizers you have used and all that, you want to inquire into them. So all of these are corrective actions that you may take in order to ensure that the variance does not happen again. So the variance can either be favorable or unfavorable. When you have a favorable variance, it means that what you budgeted is lower than the actual results. In this case, it means that you have done actually well at the end of the financial year. But it is unfavorable or adverse if what you have budgeted, is higher than the actual result. It means the actual result didn't earn you, bring up to the goal. It didn't earn you the goal that you have set at the beginning of the financial year. So then the last one is planning again. You have to plan again. Budgeting is a continuous process. So when you budget after the first financial period, you do what? You review your performances by comparing your results with the budgets you have done. And after that, you embark on the same budgeting process again. That's why we said it is a continuous process, plan over and over again. So here are 2 types of strategy. We have long run strategy and short run strategy. Long run strategy, we note that the plans, the strategy of the company will span up to 3 years and above, just like we mentioned earlier. But if the strategy is of a short period, it means that the strategy addresses concerns just for 1 year or at max 2 years. So depending on the type of planning, the type of strategy that you want to adopt, the tools available to you can either be long-run budgets if you are seeking to address long-run strategy. But if your concern is addressing short-run strategy, short-run planning, you may need to consider the short-run budgets. Cycle of money is what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. The primary function of finance is the movement of money from lenders to borrowers and back again. Every fund that is injected into your business tends to do what? Tends to rotate. It rotates. If eventually as a microfinance bank, the loan will be credited to your account, meaning it has come into your business. And the same loan that is paid to you, we have to find each way out of the business again when you start making payment for salaries and wages and you start paying suppliers and vendors who supply you with one form of goods or services. So you discover that the money that has come in initially from NISA Microfinance Bank or any other means into the business find its way out again by the time you start making payments of salaries and wages. It goes out again. And as the money goes out again, you're able to produce goods or services, and you sell these goods or services to customers. The same money that left will return, find its bearing back again into the business. So this money tends to rotate in and out of the business, and that's why we call it cycle money. So what is bookkeeping? Let's consider bookkeeping activities. Bookkeeping involves the recording on a daily basis. The recording on a daily basis of a company's financial transactions. That's what we refer to as bookkeeping. The act of trying to document, to record on a daily basis all the accounting, financial transactions of a company that has taken place. That is what we refer to as bookkeeping. So with proper bookkeeping, companies are able to track all the information on each books to make key operating, investing, and financing decisions. So when a company maintains its financial records, the company is able to track all of its activities, and the company is better informed to making operating, investing, and key financing decisions. Bookkeepers are individuals who manage all financial data for companies. If you can afford the services of a bookkeeper or an account clerk, you are strongly advised to do so. But if, on the other hand, you cannot afford the services of a bookkeeper or account clerk or a qualified accountant, there are ways you can maintain your financial record. And before the end of this training session, I will show you how to maintain your financial records even as non-accountants. I will be exposing you to a more simplified way or method of maintaining your financial records even as non-accountants. So here are the importance of bookkeeping. These are some of the reasons why companies indulge in bookkeeping activities. Number one is to provide reliable measure of a company's performance. We ensure that a company's performance is measured reliably. You want to know if a company is reporting enough profitability or losses for a particular period. You need to check, you need to prepare your financial records. You need to maintain your bookkeeping activities. It is these bookkeeping activities that will suggest to you if a company's performance has improved or declined over a period of time. Another importance of bookkeeping is that it provides information for strategic decision. Bookkeeping helps managers, owners of companies in taking key strategic decisions. Let me give you an instance. Imagine a farmer who cultivates, who has two operating segments. One of the segments is the farmer cultivates crops, and the second operating segment is that the farmer rears animals. So these are two operating segments within the same business chain of a particular company. If the company decides that due to abysmal profit returns for a particular period from one of these operating segments, take for instance, the crop cultivation is not bringing enough return to the owners of the business, the owner of the business may be able to take key strategic decisions, such as closing down the operating segments, maybe the crop cultivation that doesn't bring enough return, and channel all the resources and all the energy into the farm production or into the animal production or animal farming. So this is what we mean by bookkeeping provides information for strategic decision. Then thirdly, it provides benchmark for revenue and income goal. Bookkeeping helps a company to identify some of its income and revenue goals. When you maintain your financial records, you are clearly able to see all your revenue and income earning activities and this will help you pursue them vigorously to be sure that these amounts are actually earned and collected. Then fourthly, fulfillment of legal and tax obligations. Companies maintain their financial records, their bookkeeping, in order to comply with the legal and tax obligations, especially in this part of the world, Nigeria. Most companies, most SMEs, small and medium enterprises, maintain their financial records simply because they do not want to be harassed by the tax authorities. So compliance with tax obligation is #1 reason why people maintain their financial records, especially in Nigeria, to help them fulfill with their tax and legal obligation. Then fifth reason for bookkeeping is to provide stewardship to investors. We all know that in modern day businesses, investors are quite different from owners. Investors are quite different from managers of the business. Investors are those who have committed their money or resources into the establishment of the business, while managers are those who have been engaged by the investors, by the shareholders, to carry out the day-to-day administration of the business. So for managers to provide stewardship function to their investors, they need to maintain their financial records, because it is this financial record that is eventually used to render returns to investors. Then lastly, another importance of bookkeeping is that it helps with the proper management of cash flows. When a company maintains its bookkeeping, the company is able to manage its cash flows. The company ensures that funds are readily available to meet its short-term debts when they eventually fall due. So, gentlemen, before us is what we call accounting basis. Accounting basis. There are basically two bases of accounting. When we talk of accounting basis, what do we mean? Basis of accounting refers to the time period at which a financial transaction is to be recorded, is to be documented. At what point should a financial transaction be documented? Should it be when the exchange transaction has taken place, or should it be when the funds have either been received or paid by the company? So let's look at the #1 type of accounting basis, which is the cash basis. Under the cash basis of accounting, accounting transactions are recorded only when cash is actually received or paid. So under this circumstance, we only recognize transactions for recording only when money has exchanged hands. If money comes into the business, you record the transaction. If money leaves the business, you also record the transaction. That's the cash basis. Emphasis here is on the movement of funds, the movement of money. Meaning, if a transaction takes place and it is not paid for, or it has not been received, that transaction will not be recorded transaction will not be recorded by the entity. That's the cash basis. Don't forget, emphasis here is on cash movement. Then the second type is the accrual basis. Under the accrual basis, accounting transactions are recorded when they occur, even if cash is not received or paid. Under the accrual basis, accounting transactions are recorded when they occur, even if cash is not received or paid. Let me give you an instance. Now, you have gone ahead to purchase 100 units of a product, and you will pay for it next month. You have made purchases and you have promised to pay for it next month. You see, if you use the cash basis of accounting, because you have not paid whoever that supplied you this 100 units of product, you cannot book the accounting transaction. You would rather wait until 1 month's time when you make the payments. If you make the payments, then you can then you can record the accounting transactions. Then the second type, which is the accrual basis, like we have explained, emphasis here is on the occurrence of the accounting transaction. In this case, when you purchase 100 units of a product and you are promising to pay for it next month, the fact remains that you have taken deliveries of these goods. And for you to take deliveries of these goods, it means that the exchange transaction has occurred, exchange transaction has taken place. And as such, these transactions will have to be recorded in your financial statement, irrespective of the fact that the funds, the money will be paid next month. So I just want to believe that we are clear on the two types of accounting basis. Let me also state here that any of the accounting basis that is adopted has to be applied consistently. If you adopt any of these accounting basis, it's expected that you apply it consistently. In accounting, the profession forbids accountants or companies from using one accounting basis in 1 year and switching it in the second year or third year or subsequent years. Any attempt to do that, your financial statement will be totally misleading. It will be totally misleading. So here are methods of bookkeeping. Here are methods of bookkeeping. We have the single entry bookkeeping method. Single entry bookkeeping method. Recall, I told us that at the beginning of this training session that even as non-accountants, there are ways that we can maintain our financial transactions, even as non-accountants. So the single entry bookkeeping method will apply or appeal mostly to non-accountants. Single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. Meaning if a company uses the single entry bookkeeping, it only recognizes one transaction in its records. That's why it's called single entry bookkeeping. So under the single entry bookkeeping, perhaps you may not want to engage an account clerk because of cost. You are considering cost. You can maintain these records yourself. This is the way it's done. Some people I have seen, they will have a hardcover notebook, where they record all their financial transactions. You may have various segments, various leaves. This leaf may be for sales, for recording sales. The other leaf may be for recording purchases. The other leaf may be for recording all transport expenses, so on and so forth. I've also seen situations where companies use what we call cash analysis column cash book. Analysis column cash book. This analysis column cash book is usually sold at the bookshop or superstores, bookshop. So when you have analysis column cash book, it's a book that has various columns. So you can decide that each of the column you want to record all your transactions columns by column. You can say, oh, for this column, I want to record all my salaries and wages. The other column, I want to record all my transportation expenses. The other column, you want to record your repairs and maintenance expenses. The other column, you want to record all your transportation, travel expenses, so on and so forth. So it has various columns, and you can use those columns to record all your financial transactions. The other way you can maintain your bookkeeping yourself is by filling out the check stub. When you issue a check to a customer, to your supplier, you can decide to fill in the small bit that is left on the check, all the narrations and details and the amount involved on the check stub. That will help you in the future when you want to prepare the account. You can analyze and collate all the narrations as provided in the check stub. It will help you in preparing your financial statement. So these are simplified ways that you as an individual non-accountant who may not be willing to engage the services of an account clerk or a bookkeeper maintain your financial records at first. Then the other type is double entry bookkeeping. Double entry bookkeeping is more robust. It is more sophisticated than the single entry bookkeeping. So, on the double entry bookkeeping, it follows the principle that every transaction affects at least 2 accounts, and they are recorded as debits and credits. For example, if you sell a bag of cowpea, you just show the bag of cowpea, that's beans. You see, just for this single transaction, there are 2 entries to it, the debit entry and the credit entry. So the debit entry will be debit cash or bank, if the money was paid into your cash, if you received it through cash, or if it was paid into your bank